afternoon, and thank you for joining us today to discuss Surge Energy's Q4 and year-end results. With us today from the company are CEO Paul Colborne and COO Murray Bai. Surge trades under the ticker symbol SGY on the TSX and ZTPAF on the OTC. After the presentation, there will be an opportunity for Q&A. Please enter your questions in the Q&A box. Paul, Murray, welcome. I will turn it over to you to touch on the highlights from the year and the quarter, and then we'll follow on with questions.
Sounds good. Thanks, Jess. I appreciate the intro. Yeah. My name's Paul Colborne. I'm President and CEO. I've got Murray Bai, our Chief Operating Officer, with me. Yeah, we're going to talk a bit about the quarter and the year. I think it was one of the best quarters in our peer group in Canada. We just put out last night. Great production, beat our exit rate. We averaged over 25,000 barrels a day for the whole quarter in the fourth quarter. We're 87% light and medium gravity crude oil, no gas, no heavy oil. We are your oil play in Canada. On the year, now think of this from any other business context. On the year, we generated on a $77 WTI year, so not a crazy price year, $292 million of cash flow. And we had $94 million of free cash flow before dividends or anything. So a very, very healthy 35% of our cash flow is free cash flow. I think it stands out as one of the best oil company results in Canada for companies our size. Now, what's our secret? Why have we continued to do this? We did this in 2022. We were one of the top performers. 23, this will be one of the top quarters. Why? Why are we able to do this? Well, you're going to be surprised by this, but quality assets drive top returns. That's it. There isn't Murray's great, Paul's great, Jessica's great. It's quality assets, large oil in place, high quality reservoirs, conventional. I turn them over to top technical people like Murray. Derek Christie, our VPX, is top drawer. And you stay disciplined and you go after that recovery factor through infill, step out, water flood, horizontal, Packers Plus, multi-lats now. That is what drives the financial results. Now, I'll show you that. This shows up in your net asset value and your free cash flow yield. Murray?
Yeah, we had a good reserve year. We just finished year-end reserves. You can see our NAVs there. We're at 566 PDP producing net asset value, and then our total proved plus NAV is 1127. So great value proposition. Our PDP reserves, total proved reserves came in great. We're at 397 locations of our 1,000 locations booked on those NAVs. So lots of running room and good quality reserve year. We had a good recycle on our PDP, good recycle on our total proved.
Yeah. The second thing that is kind of the proof of the asset quality, one is reserves, and then the next one here would be free cash flow yield. I already mentioned to you that on our $292 million of cash flow that we generated, 94 million of that is free cash flow. So you see here the 9 Point Partners has Surge as one of the best free cash flow yields in all of Canada at 75 oil. Well, oil hit 80 yesterday, so we would be right near the top of the entire peer group in all of Canada. So flip one more slide, Ray. So what does this mean? Well, check this slide out. It's probably one of my favorite. With oil prices going up and actually ripping, I checked on December 23rd, crude oil prices were 68 WTI. Now they yesterday hit 80. If you do the math on that, that's about 9.8 times 10. That's almost 100 million of free cash flow just showed up with Surge. And this chart on the right is National Bank's verification of that. It's a new chart they did showing what company has the most torque, meaning most share price appreciation upside, of the oil companies. Yangara, the one at top, is a gas company, but outranking anyone in the group is Surge Energy of the oil companies, and that's exciting for shareholders. This is our guidance chart for this year, 295 million, and again, flat at 75 oil. There's that 105 million of free cash flow, and we have one of the better balance sheets in the industry with a exit debt to cash flow at 0.7. We're going to average about 25,000 barrels a day. Murray's capital program to keep the production flat is about 190 million, and that's what gets you that free cash flow. Our dividend is a juicy 7% yield, but we have one of the lowest payout ratios in our peer group in Canada. So the next slide here will just show you, this is something we came out that's new. It's on our website today. We're simplifying. It isn't changed. It's just we tried to simplify the diagram and things to make it easier for people. So what we're saying, after Murray's 190 million of capital, after our dividend, which is, as I said, over a 7% yield, we have almost 60 million of free cash flow after the dividend. So just like you saw in 2023, we paid debt down 62 million over the year. So we have paid debt down this year at 75 oil, 57 million after the dividend. So as we hit the next debt target, which looks like it'll be kind of mid Q4 of this year, which is actually now only 2 quarters away, 2.5 quarters away, that's when we would probably look at starting a share buyback and special dividends. The macro slide here, I'm not going to spend too much time, although I will say I just read a chart this morning on India. India's growth is much higher than people thought. China's growth last year was huge. China is now the largest importer of crude in the world, past the United States. We just think it's laughable that 6 billion people in the world need every barrel. And we're sitting here postulating about the price of oil and terminal oil demand. Oil demand keeps going up to the right, and right now it's actually inflecting upward. This is our key. This is our secret sauce. The next 2 slides. I'll do this one, Marie will do the next. We're going to try and show you a chart, which is just Paul waving his hands, telling you something. And then Marie will try and show you empirically what it means. Shocker. On the right-hand side, high quality, big oil in place, low decline, conventional reservoirs with great perm and great porosity, while they outperform deep, expensive, tight rock that costs huge money to drill, massive fracs, huge costs, steep declines that don't waterflood. That's it. So along the bottom, the permeability side, 0.1 millidarcy and better rock on the right, that's surge. Some of our reservoirs brought the U.S. independents and super majors up to Canada in the 40s, 50s, and 60s when oil's $3. Imagine how lucrative they are at $78, $79 today. We don't want the risk of the Duvernay, the Permian, the Montney, 10, 12, $15 million wells. Now, Murray's going to show you this empirically, how juicy this is and what it means to be a surge shareholder.
Thanks, Paul. So yeah, it always starts with our oil in place. We need high oil in place per section to get these great economics and recovery factors. We have over 3 billion barrels of oil in place. This chart shows our oil in place by core area. The two, our 2 drilling cores, Sparky and Southeast Sask, we're over 1.5 billion barrels. You can see of our locations, we're 489 booked over 1,050 locations. What's good is we've only cummed 7.7% of our oil in place, and we've booked a 10.7% recovery factor. In these waterflood assets, we can book upwards of 20 to 30%. So there's lots of running room for future PUD and reserve bookings here. There's a lot of running room. 75% of our assets are currently have water floods on them, and 25% of the production is directly affected by the water flood. So we're continuing to increase that and continuing to get those extra EOR water flood barrels. So back to conventional assets, that's why we like them, and we can continue to go after those water flood reserves and recovery factors. So I'll jump into our Southeast Sask and Sparky assets. It's now becoming 80% of our production and 95% of our capital weighting this year. Is very similar to last year, but we're continuing to spend bulk of our capital and time there. Why are we doing that? Here is Peter's research updated in January 16th, 2024. This is the North American core plays on 1-year payout or 1 times payout ranking. So the blue is where our plays are within the Peters data, and then the green is our surge internal type curves, which I'll get to in a minute. But you can see we're in the two of the top 3 plays in Canada. So our surge Frobisher wells are less than a half-year payout, amazing economics. We've had a 2 year straight of drilling over 50 wells like that on average. Then you got the Clearwaters number 2, and then you get into the Sparky multi-leg and single leg laterals in the Manville in the top 4 play there. So very good economics, and that's why we're spending the bulk of our capital there. Here's our Sparky play. It's 11 billion barrel trend. We got in there early, over 10 years ago. We stuck to the 20 API light medium window single leg fracked wells. We've now drilled over 225 of those. But with the advent of the multi-leg technology in that halo play, we're calling it, gets a little heavier window. We're starting to drill multi-leg wells, and I have a further slide on that. We've drilled 18 to date, and we're getting encouraging results. So we're continuing to get land, do organic exploitation and move into that corridor. So you see that as an upside for us. What does that mean? Here's what we've done in over 10 years, gone from, just under 2,000 barrels a day to now over 12,000 barrels a day. So we have that constant growth. It's been a great asset for us. Over 1 billion barrels of oil in place, 470 locations. This year we're drilling 35, 40 locations to put in context. So you have over 12 years of drilling. And now included in that number, we have over 85 multi-lat locations. So yeah, here's a snippet of our multi-lat development where we're drilling the multi-lats throughout the play, kind of in that heavier corridor. So it's not just in one spot. So in Betty Lake, we've done a few 2 mile multi-lats. You can see the results, IP90s of 319 barrels a day. Macklin, we had, wells where we started at 225 barrel a day, IP90 wells, kind of got us kick-started. And then since we've acquired, over 20 sections at Hope Valley, and we just drilled our 3rd well there, a 12-leg multi-lat here in Q1. It's been on 4 or 5 days. Initial oil rates are looking very encouraging. So we're just excited. We'll have more info on that in our Q1, but we only have 35 of the 85 lokes kind of up at Hope Valley in our locations, but I see upside of over 100 locations there. So time will tell, but it's early days and encouraging results there. On the right, you see our economics, why we're chasing this 154% rate of return, less than a year payout. So it really augments our good waterflood single leg fracked wells, and it's a new thing we can chase. Here's an example of what we've done organically and through acquisition at our core Provost Cadogan area. We have over 240 million barrels in place here. This area not that long ago was 2,300 BOE in January 2021. We've now taken it over 4,500 BOE a day. The yellow is our existing organic land, and our green was the acquisition of Enerplus. But you can see what we've done and drilled to continue that growth. So we're getting wells 150 barrel a day, 170 barrel a day, 130 barrel a day, great economic wells in this area, less than a 1 year payout. So
yeah, I was just going to ask, how much do you have to spend to increase production by that much?
Yeah, so we've drilled in this area in the last couple of years about 20 wells. So yeah, it's not been, it's like $30 million plus the Cadogan acquisition was about 1,000 BOE, but there's been a lot of organic growth drilling on those acquired lands. Plus the green lands there had no Sparky production, essentially. So they didn't have any PUDs booked there on the Sparky. They didn't have any horizontals drilled, so we were able to go tackle that. There've been great results on there.
Exactly. I guess that's why I was trying to highlight.
Yeah, so we're 25. I love our strategy. We're paying down debt. We got our debt targets. We're 25. We had a great organic year. We're 25,000 barrels a day for the next 23, 24. But within that, we have great asset quality and great growth stories happening within that 25, keeping production flat. And it kind of segues to we can grow. We just want to get to those debt targets first. We have the inventory and the assets to do it. But I like the strategy of let's get the debt down, and then we have that pivot at that time when we get there. Just on a reserves basis, to put this in perspective, our 2P reserves in the Sparky are now just under $1 billion. So it's, 40% of our total company value. And I'll get to the Southeast Sask. So the two core areas are 85 to 90% of our total NAV now. And so that kind of ties to why we're the capital and the production as well. So jumping into Southeast Sask, you can see we have a balance here of our Ratcliffe waterflood, nice EOR, low decline pools, our Midale we're water flooding, and then the juicy Frobisher trend we're drilling with those great economics. So the Sparky business unit was 22% decline. This business unit on reserves is 34% decline. And then our total company is 24. So it's what's nice here is having those water floods, and we're continuing to do that to augment the decline of the Frobisher. So to put that,
and unlike a lot of companies, you have actually a lot of mature water floods as well, and a lot of experience doing them. So many people try them and they don't work out so well. That's not the case with Surge.
Yeah, the Sparky, if I go back, I didn't mention that, but on that sheet, we've added over 9. The blue wells are hard to see, but we've added 9 injectors in the last 2 years, and we're continuing to do that in all our pools. So the horizontal water floods are working quite well. And so we pre-build all the pipe for water injection. So it's really easy for us to convert and continue this water flood. So we're seeing the reason why we have a multi-lat in this area is that the single leg wells are working really well in the flood. So to your point, Jessica, we got mature floods and we're adding the new flood. So in Southeast Sask, we're over 8,000 barrels a day. This chart here is public data for the last 2 years. So in the last 2 years, Surge on the far left, we've drilled 56 wells in the Frobisher, and our average IP 90 is just under 180 barrels a day. So phenomenal results, and I'll get to those economics. So here's Steelman, and why are we doing this? Is we're essentially doing multi-lat wells here as well, but they're stacked vertically. You can see the top log there. We'll have 3 different 2 to 3 meter pay intervals, and we're putting an open hole leg into each interval. And we're getting, a 3 well, let's say we drill a half mile long, but you're essentially drilling a 1.5 mile well with 3 legs. So multi-lat technology in a sense, just vertically. So with these wells, these are the payouts we showed earlier, but you're 0.4 of a year, 500% rate of return, the IP90 at 180 BOE, that ties to those 56 wells we've drilled. And we see, we have over 120 locations just in this area to continue. And we're drilling, 35 wells a year. And the team's done a great job of augmenting our land base. So the green here is what we acquired and what we started in end of 2021. The yellow is all the land we have since added through crown sales, farm-ins, acquisition, like small tuck-ins. So very organic adds, and then the drilling. So this area was 1,700 BOE a day when we acquired it, and it's now 3,500. So we've more than doubled this area with these great results, and the team's done an awesome job of augmenting the land position here. Just to throw out a couple of results, like this one, the 1 and 3 well we drilled, it's in the top well in Saskatchewan, reports by everybody. It came out last month, 550 BOE IP30. It's the best well in Saskatchewan. There's other wells near 225, 230, 348, just, pointing out some of our recent results. But just what's fun for me is we've had 2 years straight of drilling those wells. It's not like one section, it's throughout the pool, and it's continuous great results.
So it's just before we leave this slide, how long have you been using the 3 leg laterals now?
We've been, when we acquired, there was a few 2 legs. We went to mostly 2 legs, but in certain areas where we have the geology, the 3rd leg has kind of been added last year. And to be fair, some of these bigger wells, that's part of it, is there's a lower zone that maybe guys would have thought are wet or something, and we've been testing it and it's fine. So, how did this play exist? Why didn't somebody drill this 5-10 years ago and get these great wells? It's people thought some of these zones were wet, technically, and we've cracked that nut, and they're not wet. Like, we're getting great oil cuts. So, and the other thing about the Frobisher technically is it's active bottom water drive, so you don't have to water flood it. And that I try to explain to people, that's why the economics are so good, is you're essentially getting free water flood up front. Like your reservoir's pressure's high.
It pushes though.
Yeah, you're getting push, you're getting bottom water drive push. So you're kind of getting a free water flood here. Like, so you don't need to come and water flood this. You're getting natural water flood. The primary.
Oh, yeah. Sorry to interrupt, but I was just
Yeah.
going to say, one of my questions was going to be, remember when you bought this, what was it, 2.5 years ago now?
Yeah, it was October. We had both acquisitions kind of done the end of 2021, and I just went down the hall to get that. We were doing 1,700 BOE after both acquisitions, and now 3,500 through drilling and land sales. So there was no other major acquisitions. So like some of those land sales in there, it's amazing those wells we've been able to get there, and there's been some good farm-ins done lately.
And we still have just 120 locations.
That's my next question.
I think this is probably the single best reservoir in Saskatchewan right now because the OPEX is about $8, so the netback could be over $70 a barrel here.
Yeah, this is what's really nice. Like diffs were out a bit in Q4 and Q1. They're coming in nice and tight with TMX, but then this helps our cash flows a lot with a chromer light oil and no real diff issues here. So you're getting phenomenal netbacks.
So would you say this is a combination of really good, better quality reservoir and the way you're completing it, or?
Yeah, it's going longer wells, more zone, like to your point, going to the more legs per well. Like a lot of guys initially were one horizontal in one of those zones and going to 3-leg wells. And it's the bottom water drive pushing, helping us out.
Perfect. Okay.
Yeah, these wells, and that's fun here is we're not fracking. So these wells, we're not fracking our multi-lats in Sparky. So, you're drilling 35 Sparky wells, let's say this year, probably 8 of those are multi-lats. So you're kind of down to 25 wells a year. We're even fracking and they're small fracs. I know there's actually water issues with the drought but we have really small water usage with our program, and we're fine on that aspect. So yeah, the reserves here, it's now, 35% of our NAV. So like I said, you add this in the Sparky and we're over 85% of our total NAV is these two plays. Paul did mention that like our 2P F&D was a little high, but that was a write down in the non-core due to some gas pricing in Valhalla, some NGLs at the plant. But I feel that's a non-event in our non-core when our non-core assets are becoming like less than 15% of our NAV.
And that was a non-cash write down anyway, right? So,
right. Yeah.
But even just it's 3 million barrels on 122 million of reserves, and they're uneconomic gas plus.
What's economic at these gas prices?
Yeah, so and it's in the P plus P category, which is $20 a share. Like it's just cleanup.
So Valhalla, don't talk about it, but Valhalla is 50% gas, 50% oil. It's our gaseous play. The rest of everything else is pretty much not much gas. So on a reserve basis, half the reserves are gas. So it got hit a little bit with the gas price. If that try to clarify that. Just 2 seconds on our sustainability. We're really proud of our ARO spend and what we've been doing on abandonment. So, over the last 5 years here, we've now over 900 wells have been abandoned. We're abandoning over 2 wells for every well we drill. So we're really committed to that. We're up to over $12 million a year on abandonment spend. Our emissions, this is our GHG emissions chart. You got the oil sands and the global average is 0.05. There's our yellow line, and you can see how we've dropped since tying in Southeast Sask, which we were proud of. We did a 40-kilometer pipeline, tied in all our gas there, and way below industry standard on GHG emissions. And we're continuing to focus on that. And I did talk about fresh water. It's in the forefront right now with Alberta drought. But like we're the lowest, like a really, really low freshwater use due to our basically not fracking any wells.
I'll just close up with this one slide. So there's this updated for this morning. We're covered by 12 analysts. The pending is Jeremy McRae moved over from Ray J to BMO. He's one of our top analysts. So if you look at the bottom there, what do our analysts think of our amazing quarter we just put out and year? Well, on the new target prices, we have the best share price appreciation as the top 12 analysts that cover us think in the whole space. So thrilled about that. Bottom line is that was a heck of a quarter and just into an unsettled market, but the market will pass and the top firms will go on. And I'm thrilled. I didn't realize this until the new Peters study came out. We're now in 80% of our companies in 2 of the top 3 plays in all of North America. And that's what generates our top financial results. With that, I close by saying we're open for questions. Murray is here and he's up to date and our guy on any of the reserve information, our quarter. So I think we'll turn it over to you, Jess, for questions.
Okay, I'll start with some of the ones from the audience. Across the small to medium E&P space, what do you expect to happen in terms of M&A in 2024? And then I would add to that specifically, in the case of your asset base, how many of your locations that are booked right now are tier 1? So that would have to compete for capital for any kind of M&A you would do. So
I'll answer the first part, and then Murray's going to answer the tier 1s. M&A, we just put this entire year out. It's going to go down as one of the top, I think, 2 ourselves and maybe Headwater Oil quarters and years in Canada in our peer group of the intermediates oil companies. We do see some M&A, but we have a pretty high threshold for the things that we want to own and buy, as you saw on some prior slides. So the whole year we delivered, including a record Q4 for us on production, like beating our exit rate target for the whole quarter. That was all organic. So we are looking at different things. We're always looking at the market, but given our depth of inventory, 1,000 locations, and we drill at a pace of about 70 a year, that's like a 12, 13-year inventory. So I'll let Murray fill you in on how many are tier 1s.
Yeah, really with our asset quality in the Sparky and Southeast Sask, so you got your over 400 in Sparky and over 250 in Southeast Sask. We have the remote, like over 2/3 is tier 1, tier 2, and over a half is just tier 1. So we have 3 to 5 years of drilling tier 1 locations. So we're not in a rush to go at 75 well. We're not in a rush to have to add inventory. We're always looking at the cupboards, though. We always want to add. And to your point on acquisitions, that's where it becomes challenged. Is it's hard for us to find good PDP assets with those tier 1, tier 2 locations, because it's hard for us to go buy something and not drill it. And we're kind of seeing that in some of our non-core, and that's just kind of happened through our own success. But it's hard to find M&A. So we got to find M&A in our core areas that compete, that kind of bring some tier 1 locations.
Yeah, but you don't really have to either. That's the other.
Yeah, we don't need to. Yeah, we don't have the pressure. Like we were quite disciplined last year. I use the word, like Paul, we didn't do an acquisition last year. We looked at a lot, and we're kind of in the same thinking right now. But we're always hunting in that Sparky bucket, and that Sparky area could be getting bigger with some of those multi-lats, and we're definitely scouring the Southeast. But yeah, it's got to be accretive, tall metrics, and be competitive on our inventory basis.
Now, one question on the multi-lats while we're there. How many are you going to drill this year?
I think we drilled 4 in Q1, and we have like 4 to 6 depending on results kind of for the second half. So call it 10 wells. And we're very nimble, like depending on results, we can jump back to that pad, add wells. So very flexible, but yeah, kind of 10 wells planned right now. And we're just, to continue furthering that play and keep learning here.
And so you ran seismic, so you probably have a better idea while drilling them now.
Hope Valley, if you step back, it's been a 4-year process of just to show, our patients, like get the land, get the 3D seismic, drilled a well. Now we've drilled our first well on the 3D to your point. And what we're encouraged is, we'll see that data, that well's brand new, but when we were drilling it, it was about 90% rock quality in the zone. We were able to steer better versus, our previous wells without the 3D were more like 60, 70%. So we definitely saw rock quality in the reservoir improvement drilling that well with the 3D. And we were also able to pick our best spot. So we're encouraged with, we spent $3.2 million on the 3D, 47 square kilometer. And so, we're transitioning that area, but it's really simple. Jess, if you drill a good well, we'll go there fast.
Yeah, exactly.
We're very nimble. Like if it's good, we're going to pivot and we'll put
you'll put more capital there.
There'll be a rig there and we'll be going.
Yeah. Okay. And again, remind me the number of locations you said you had there?
10. Well, sorry, we have 35 of the 85 multi-lot locations, but with success, we see over 100. We still have those. We don't want to have them all in our location count yet.
Yeah.
So we get more results.
Okay. All right. Just seeing what else. I'll maybe take someone from the audience here. Why such low ownership of stock from both management and the board?
I think we're around 3 or 4% ownership for a bigger public company. That's pretty good. I think I'm the fourth biggest shareholder in the whole company. Rob Leach, one of our big directors, Murray's a big shareholder. We're all pretty big shareholders, so I'm not sure where that. Like, I think.
You're pretty good ownership. I mean, there's some. I mean, obviously that, like you say, smaller companies. If you didn't start this company either. Remember, like you took it over, so that's another factor. How do you explain the debt increase Q over Q? What does this do to your phase 2 plans? Well, you already said you meet your debt target probably Q4. I just may add to that, being that you're ahead of your production, you've been ahead of your exit since all through Q4, and obviously you'll have some good flush from Q1. When you go into Q2 with your and your capex goes down, will you be able to accelerate debt payment a little bit more, do you think?
Yeah, so in Q2, we just had our weekly management meeting. In Q2, we're going to reduce our debt over 25 million in 1 quarter. It's actually close to 30. So it's just, we don't manage the company to quarters. We manage it to years and in accordance with our 5-year plan. So yeah, some quarters because crude oil prices ripped and went from December, just last December, 3 months, 2.5 months ago, 3 months ago, crude prices hit 68. So we pulled back some capital. Now we put some capital back in and had a really good Q1. We're going to pay debt down 25 to 30 million at these prices if oil stays where it is in Q2 alone. So we're on track. Sometime October, probably November would be better. Sometime November. Well, now we're in March, so it doesn't sound so far away. And if you see the math on the capital return of capital framework, we could double the dividend. Double it. We already have a 7% yield. We won't do that. That would be foolish, but it just shows you we have a huge amount of cash as we hit the next debt target that we could put to the dividend. We'll tweak it up a little, maybe 8 or 10%, but we'll keep putting it on the debt and start a share buyback program is our thought.
Yeah, and Jessica, it's operationally, it's normal for us to spend more December through February
of course.
with the breakup. So part of that is just a little higher capital December through Feb. We're almost down to 0 rigs as of this week. So it just shows you what breakup is. Like we're done, like we can only spend in Q1, Feb. And so we ramp up December to help with that as well. And then we have, a few months here where we can't drill. So it's normal to have those quarters a little higher on capital.
Oh, definitely. Yeah. But then it works in your favor a little bit.
Yeah, Q2 will get back. And, part of that was, I think another main reason on that was the diffs came out a bit in Q4 and Q1. And the other
That's what I was just going to say. Yeah.
The other thing we saw in the management meeting is diffs is on strip as tight as $11 in the second half. And
that should continue as we, and
that's a big part for ours because like all our Sparky barrels are on trade on a WCS basis. So that's a big torque for surge with Trans Mountains filling here, getting line fill and the diffs coming in. They were out to 18, 19 and they're coming into 11.
Well, and that's what contributed to your debt being up.
Yeah, that's really actually how I look at it is the diffs came out a bit in Q4 and we weren't, and we do some good hedging and stuff, but we really see the light at the end of the tunnel on the diff swings with TMX.
And that should be a longer term.
We feel that's a more structural, longer term thing. Yeah. And to your point, we are, we're kind of looking more on hedging there because even if they're 12, 13, set it and forget it, like we'll hedge a decent amount of our WCS exposure.
Okay, that answers one of my other questions as well. You're thinking ahead of me, Murray.
Okay, sorry.
That's okay. Assuming $75 WTI, how much cash does management expect the company will be paying in taxes once your $1.4 billion of tax pools are depleted?
The tax pools now are 1.2 billion, like after our.
Oh, sorry.
No, 1 point. It's still about a 4-year horizon at 75 oil. So if oil goes to 80, 85, that horizon comes down. But yeah, we have almost half our pools are the non-capital losses, the high quality pools. So really have a good tax pool. I think us and Cardinal are the two best in the entire group.
So sorry, I haven't calced that because it's 4 years out. The actual dollar on the net back, but looking at some peer, I just been looking at some peers, and a lot of peers there that are fully taxable are in that $3 to $6 a barrel range to taxes.
Yeah, I think Tamarack's $6 a barrel is what.
So it's kind of goes around to 20% of your net back, almost like 15% of your net back.
Wow, $6 a barrel.
So it's like upwards. It goes to about $5 a barrel.
Okay. Your OPEX came down by 236. Is that a function of power prices?
Yeah, mainly structural. The power is down. Our volumes are up too, helped. But we saved about $2 million on power. We have done big power hedges. We're up to 70% of our power hedged in 2024 at $68 a megawatt hour. Spot prices are still in that like 80 plus, and the cold snap there, they go to 200. So there's also a structural thing where we're slightly more hedged this year, just kind of taking that volatility out of power. But yeah, you're right. It's about $1 a barrel just on power, like 50 to 80 cents on power. And then our volumes were up. So we've kind of seen that inflation on capital and OPEX, but everything's kind of flattened out now. We think OPEX maybe slightly down with the power, and capital's kind of hanging in there without inflation. So we're kind of in that $20 to $21 OPEX now. We should be able to hold. Q1's a winter quarter. Yeah, Q1's winter. It's always up a little with winter propane and power usage up for the winter. But we should have I'm foreseeing a good OPEX here go forward from that Q4 result.
Okay. Someone's questioning, can you explain how Sproul evaluates reserves? It seems like they're underestimating reserves. Do you agree with that statement?
Yes. So Sproul I don't want to make this too complicated, but basically they're a P50, which is the average. They have to be conservative on a PDP basis. They have to be conservative where it's like 50% chance guaranteed that it'll hit this number. So, our internal type curves will be anywhere from like 10 to 20% higher on average of a proved type curve. On a total proved plus where probable comes more into line with our internal type curve. So it's just the COGI reserve rules that all auditors have to follow. And it's really they have to be 50% certain it's going to hit that number. So they're slightly conservative on your PDP and on our all our PUDs. That's just that's the reserve business. That's how all the auditors in Canada are.
Back to the Sproul. It's a good question, Jess. I just wanted to show it's way back.
Yeah, way.
I just wanted to show people this slide. It doesn't get much better than this. When you look at the netbacks we have, here's our new Sproul. So we're trading in the 6s. Our total proved pretty low risk NAV with only 397 of our 1,000 locations booked is 1127. We're trading in the 6s. And you got the dividend, but our P plus P is still on the new lower Sproul price deck for oil, and the higher, they put some extra inflation in the numbers. It's still 1763 a share. And it was 22. So that's a point that we raised earlier, is that we're got to be one of the best value propositions in the space.
Yeah, what I talk to it as, reserves is a health check. I thought it went well. And then I'm just focusing on the total proved just because it very well aligns with our analyst number, with our I just missed it, 1160 a share target price and our total proved, and we can base that valuation on a NAV. So there's 3 different ways to value a company. You can do it on NAV, cash flow, or a few ways, right? So it's nice to say you're on a cash flow basis, it looks good, and on a NAV basis, it's backed up there. So I think Sproul is a bit conservative on the 1P, but 397 locations, we're drilling 70 a year, right? So,
Yeah.
5, it's kind of 5 years drilling.
Well, and if I think back like 15, 20 years ago, there used to be a lot of variability with reserve engineers. And I think that they've got a lot more consistent across the board now.
Yeah.
Correct.
The one thing I will say that people don't, the COGI rules, which is like the engineering rules, handbook rules for oil conventional, is kind of 5 years drilling you can book. What's interesting in the Montney resource plays, they're allowing them to book up to 10 years. So there is a different rule when you're looking at Montney players where they can book more unbooked locations on a timeline basis. So they can book where it's up to 10 years of drilling on resource plays.
Interesting.
And the Montney is one of those. So as a conventional oil company, we can't book like
as aggressively.
Like we couldn't do like on a Montney, you could do more lows. You could do more.
But some of those just are the biggest blowups this year when you see the
I was just going to point that out.
Gas price deck. Yeah, like some of these wells, some of the wells on the current strip would never pay out, but they get to book them in decades into the future. And anyways, I'm thrilled. Murray did a great job with Sproul this year, and to be able to go and say, hey, total proved NAV on a lower Sproul price deck is $11.27 a share, and we're trading in the sixes. That's a value proposition. We're thrilled with it.
Well, yeah, you're having wells that pay out in 4 months and or 5 months, and some of those Montney wells pay out in 2 years.
Yeah, and the other proof that Murray mentioned, and I think you're captured when you saw it, but on 292 million of cash flow, 94 million of that is free cash flow. In other words, profit after your costs of operation. What other business, in any business, a 33% free cash flow yield or free cash flow result would be 35%, I think it is. It would be crazy.
Yeah, and we have the ability to grow, but we're very prudent on this. And what I like about it is, if we have our debt to phase 3, let's say we get to phase 3 and the stock's still 650, well, we probably won't grow. Like, why? The market's no one's paying for that.
Buy the shares,
or we'll kind of see what the market is and see what the world is when we hit these levels. But yeah, right now the share buybacks sound good, right? Like our stock in the sixes, we would probably push more on the share buyback right now.
Yeah, it makes more sense.
And that ties back. That's what's so good about those reserve NAVs is if you can buy your stock around just above PDP, we may as well do the share buyback.
Any non-core assets you have for sale?
Yeah, we have probably, as Murray said, we're getting more and more cored up, where over 80% of our current production and 90% of our cash flow is from two of the top plays in North America. So we have probably around, I'd say 2,000 to 3,000 barrels, maybe a little more that we're looking. We could put out a package this spring. Something like Valhalla maybe, or Greater Son, or Shaunavon. So yeah, we've got 2 or 3 assets, but they're good. They're solid. They deliver cash flow, free cash flow today. It's just if you don't put capital in, when you're drilling 2 of the best plays in North America, the other plays we like, they used to be core to us, but we're like, okay, they're capital starved. They atrophy a bit. The OPEX goes up. We love them. They're good assets, but there might be a time where we just trim those out of the inventory, but they're now getting to be pretty small to the overall corporate size.
So yeah, we're evaluating that. We'll just see what the market conditions are, and we don't have to sell them. We'll just kind of
but if we can
get a good decent like a reasonable price and core up, like sell that and core up more or something, that'd be a good pivot. But we're evaluating that for this year potentially.
Okay. It seems you have a lot of retail shareholders. How can you attract institutional investors? I'm going to speak to that a little bit before you step in. I'd say market cap minimums have changed dramatically for funds, and you guys aren't at that $1 billion mark, which is kind of the bare minimum for a lot of institutions as far as small caps go. And I think, as you grow and if you get to the point where you get put in the index, that's also would be another catalyst for institutions to enter the name, but you're kind of in that in-between space, unfortunately, and not quite at the minimum market cap needed to get bigger institutions interested. Fair? And there's not as many as there used to be either. Like
Jess, I agree with you in one regard, but I'm not too worried about it. The bottom line is, if we grow a good company and put out great quarters, smart people like you and the people on this call and smart institutions, they'll want to own this stock. And when you start looking at what we have, I don't know anyone other than maybe Headwater that has the asset quality we do, the balance sheet we do, the free cash flow we do. And we're a true light and medium gravity oil divco. And there are not that many in our space that have good balance sheets, low payout ratios. So I'm kind of thrilled, frankly, about our positioning. I'm not too worried. We were set to go in the index when Russia invaded Ukraine.
You were almost there.
Our stock ran from 368 a share to 1350, and we have 100 million. So around $1.3 billion, we were in the index. And price of oil came down and our stock dropped. But all I'm saying is, if we see the right deal, we'll do it. Or it's not a driving concern for us, because I think the market isn't recognizing where Surge and some others we're at traditionally low multiples to what we traded at in the past. So I think the market will recognize that as guys pivot out of tech, the Magnificent Seven, rotate their money out.
We're starting to see that happen a little bit already.
Exactly.
Which we saw in 99, 2000. But really, the overall number of institutions, like passively managed money, is now overtaken actively managed money, which is another issue, right? So you have, it's not like there used to be an abundance of funds that would, play all these energy names and would go down market. Now it's been really gutted for the most part.
Yeah, you're kind of have to get to 35,000 barrels roughly, but to Paul's point, we got to do that accretively and well thought. We're not in a rush to do it. If we get the right things, we will, but we're not in a rush to do that.
Yeah.
It's obviously nice to get index and get those institutions, but we'll kind of work away at that.
Sometimes it's also a curse when they decide to sell.
Yeah.
Okay. The company plans to spend approximately $10 million on water floods in 2024. What effect will that have on future sustaining capital?
Yeah, we're really just throwing that. We don't put a lot of production forecast in because we're shutting in a little bit of production when we do that. But we just see that as continuously helping our decline, like whittling away. We're at 24%, get that to 23, 22. That is one of the pivots, though, I think we could do get to these phase 3, phase 2 debt targets, is we could start out. We have lots of running room to add more to the water flood. So, long story short, I think it kind of helps us 1% a year sustaining our decline. It helps our decline about 1% a year. But then I do also feel that as a capital allocation dial we have once we get further along on our debt reduction.
What's the timeline for booking secondary water flood reserves?
Yeah, so that's a good point. Is you do those 9 injectors at Provost, like I showed, and the first year you get a little bit of reserves. Then the second year you get a bit more, and then the third, fourth year showing grid response, you get most of them. So that's the other thing in the background when we're doing our reserves, is you don't get every water flood barrel day one when you convert a well. So it takes a while to. Yeah, so those water flood recovery barrels just keep coming year after year. It's a march. It's the 10,000 march. You just keep doing your flood spending, keep optimizing the floods, and you get those reserves year over year.
So Jess, I have one little tidbit for you on the new engineering that Murray and the team put out yesterday. Our Enerplus, the 2 beautiful water floods we bought, 4,000 barrels a day for $250 million a year, just over a year ago. Mm-hmm. We've probably seen somewhere 75 to 80 million of PDP bookings, just as the reservoirs outperform the price or the decline curve that Sproul would have put on them. And that's our own internal guys, Ian Fudge and our team going, man, these things are phenomenal. They have low decline, and we felt they were underbooked on PDP. So we've seen probably somewhere 75 to 80 million of PDP, and you don't get it, as Murray said, in 1 year over the last 2 years. And it's just kind of thrilling to see that show up.
Yeah, the Ratcliffe and those floods performed
phenomenal.
Quite well. Yeah, basically where we get the most technical revisions year over year is on those mature floods that are working well. You just every year get a click of reserves.
You get an addition, yeah.
Yeah, because they don't decline as much, and you get another year of reserves. So, yeah, no, that's what we like about conventional oils. We have that, that EOR barrels too.
Okay, can you comment generally on the carbon tax, and if recent announcement in Southeast by Saskatchewan government will make costs lower in Saskatchewan versus Alberta?
So I can speak to our carbon tax. It's interesting. Carbon tax is fully in the reserves now too. So we have this year we paid $850,000 of carbon tax, and that was at $65 a ton. That's ramping up. But surge, for example, with the tier program and the OBEPS program in Saskatchewan, we ramp up to about $2 million of carbon tax. When they put that into perspective, our OPEX is close to 200 million. So it's fairly minimal in our company, but that's why we are continuing to do the fuel vent flare ESG gas vent flare recapture the gas and help the carbon tax. So long story short is in the Saskatchewan, we did our 40-kilometer pipeline, tied in that gas. That was our baseline of flaring and was prior to that line tie-in. So that's part of why we did that project. And we tied in over 4 million gas a day. And now our baseline's really, we've dropped our emissions drastically. So we don't have a big carbon tax risk in the short term in Saskatchewan. Just, I don't know if that helped, but yeah, we're paying a bit of carbon tax, but not that bad. And we're working at it.
Okay. Someone's asking, will there be new shares issued in 2024? I don't.
Right now, we have no deals pending or whatever. There's a couple little private codes we're looking at that we always do look at things, but nothing really on the plate to issue shares. We did all of last year. It was a fully organic year, which for me is a long time, but with the inventory we got in the drilling results, and you can see it show up, Jess, in our Q4.
Yeah.
We were not planning to average over our exit rate for the year for the entire quarter, and Murray and the team and Derek Christie had a great drilling result in Q4. You've seen that we have about a 12-year drilling inventory, so the hopper's pretty full. So we're not saying we wouldn't look at acquisitions, but right now I think people would say it's a pretty coveted inventory we've got. It's a really deep inventory.
Yeah, definitely. So I don't really see anything that we haven't really touched on here. Just one, given that boomer of a well, the Frobisher well you drilled, does that change the type curve going forward, or?
To be on the upper end of it.
Yeah, we typically like that. Yeah, that section we've acquired will be good, but there is variability in there. In that same area, we drilled a 250 barrel a day well, then a 500, and then 140. So there is variability. They're all great, but I don't think we'll shift our type curve yet. But what's nice about the Frobisher, what I would say is that there's the ability to beat your type curve, and that helps our numbers. And Sparky, it's fun too. It's just very consistent. So your type curve is 120 barrels a day. Every well is almost 120 barrels a day. You don't drill too many 200 minus the multi-lats, but in the Frobisher, you can beat your type curve for sure.
So Jess, we're already the number 1 or number 2 driller of all those companies at Frobishers. So I think our type curve's really, the wells pay out in 4 months or 500% rate of return. I'm pretty happy with that type curve.
Yeah, we want to try to hit our numbers.
And if you saw the new study, if you take our type curve and put it in there, it's the number 1 play in all of North America. Now, it has been for the last 75 years, but the people's view was it's getting tired or it's old, and we've gone in. A lot of the bigger companies are selling out in Saskatchewan, and give credit to our team. We've gone in and we've gone from 0 to 8,000 barrels a day in less than 3 years. And the Frobisher, we have close to 200 locations on the Frobisher, 300 almost in Southeast Sask. So we've got a deep inventory of those juicy locations.
Yeah, you definitely do.
Yeah. What's nice about those Frobisher wells being so good is it gives you the flexibility to do step out exploration a little better, because you can go drill 100 barrel a day and it's still pretty good. What's exciting for us is not every well has to be 500, but it gives you that opportunity to do step outs, add land. Look, we're exploring, we're organically looking at a lot of prospects, and those economics give you the ability to go chase a few things.
Awesome. Well, I think we've covered a lot in this call, and I don't want to keep it going on too much longer. But I mean, you're trading down today. You're almost an 8% yield, 15% free cash flow. I don't see a better entry point, really.
We're excited, and I do think the market is just. We think it's some quant funds today.
Yeah,
one of the best quarters we've ever put out. So we're kind of laughing at the market trading down a bit, but
I couldn't. No one was complaining to me about anything, so I don't.
No, all 12 analysts love the quarter. So
okay.
Well, thank you.
Yeah,
really
thank you very much.
Thank you so much for your time. And if anyone needs more information or one-on-one with management, please let me know. You can email me at jessica@adcap.ca.
Sounds good. Thank you.
Thanks, guys.
Thank you.
Yep, bye.
Really appreciate it. Bye.